Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Weekend Review where I talk about current events for the everyday investor and home buyer. Our topics for this week, topic number one from interest.co.nz on the 20th of November, independent global economic researchers Capital Economics say despite their expectation the Reserve Bank of New Zealand will slash the OCR to just 2.25% in 2025, the housing market price recovery will be muted. Topic number two from the Mortgage Mag on the 19th of November, mortgages harder to get over the line. Topic number three from the New Zealand Herald on the 19th of November, landlord paid $4,000 after $40,000 worth of damage, goes to Tenancy Tribunal. Topic number four from Stuff on the 21st of November, investors on the rebound and first home buyers still strong in a sluggish market. Topic number five from RBNZ on the 21st of November, capital gains tax, the best way to raise revenue as New Zealand's population ages, Treasury. So all of the links to these articles are in the show notes below. Topic number one from interest.co.nz on the 20th of November, independent global economic researchers, Capital Economics, say despite their expectation the Reserve Bank of New Zealand will slash the OCR to just 2.25% in 2025, the housing market price recovery will be muted. Independent researchers at Capital Economics forecast that New Zealand house prices will rise by about 4% in 2025 and 6% in 2026, signalling a restrained market recovery. Marcel Thielent, CE, that's Capital Economics, head of Asia Pacific, attributed this muted outlook to stretched affordability, despite expectations that the Reserve Bank of New Zealand, the RBNZ, will reduce the official cash rate, the OCR, from 4.75% to 2.25% by 2025. Valiant explained that while the anticipated rate cuts are the steepest since the global financial crisis, mortgage payments relative to household incomes are at record highs for the start of the rate cutting cycle, limiting the potential for a significant rebound. New Zealand house prices soared nearly 50% between late 2019 and their 2021 peak, but have since fallen by about 20%, following OCR hikes to 5.5%. Since early 2023, prices have remained flat, with modest rebounds in home sales and a decline in mortgage rates by over 1 percentage point. Valiant suggested that further OCR reductions could significantly improve affordability, though systemic constraints remain. Valiant pointed to declining net migration as another hurdle, with levels now below pre-pandemic norms. Stricter immigration policies and a higher unemployment rate compared to Australia are expected to keep population growth subdued. He acknowledged government policy changes that have made rental property investments more appealing, but noted that investors only represent 20% of purchases, and any demand boost from these changes has likely already occurred. Valiant suggested that prolonged flat house prices could improve valuations over time. Rising disposable incomes projected to grow by 4.5% annually, combined with falling interest rates, could bring house price to income ratios back to 2019 levels by late 2026. If housing prices remain steady, affordability could return to its long-run average within the same timeframe. While these trends may support gradual market improvement, Valiant emphasised that affordability challenges and muted population growth will continue to limit the pace of the recovery. Topic number two from the Mortgage Mag on the 19th of November, mortgages harder to get over the line. A recent survey by economist Tony Alexander highlights growing frustration among mortgage advisors due to extended loan processing times. Most banks now take at least 10 working days to assess applications, negating some easing of lending criteria. The proportion of advisors reporting increased bank willingness to lend has dropped sharply down to 17%. That's down from 34% in October and 57% in September. Many advisors cite ballooning processing times as the main cause. Buyers frequently need to request up to 15 working days for finance approval, yet securing a deal remains challenging. Advisors have expressed concerns about banks prioritising direct customers over advisor-submitted applications, with some noting that clients receive quicker approvals when bypassing the advisor channel. First home buyers, FHBs, without a 20% deposit face additional hurdles as banks increasingly prioritise existing customers and live deals, such as signed sale and purchase agreements. Some delays stem from banks' reduced test rates, leading to higher loan demand. ASB, for example, temporarily paused new pre-approvals to clear a backlog caused by increased interest from first home buyers, investors, and refinances. Advisors have criticised such measures, citing instances where direct applications were approved faster than those submitted through advisors. The Commerce Commission's recommendation that advisors present clients with 3 loan quotes has also added strain. While intended to encourage competition, advisors argue this approach bogs down the system, as each quote requires a full credit assessment, further slowing turnaround times. Despite frustrations, market activity is rising. Around 55% of advisors report increased interest from first home buyers, and it's the highest level that we've seen since October 2023. Falling interest rates appear to be driving optimism, with buyers expecting stronger housing activity. Investor demand has also surged, with a recent 60% of advisors noting increased activity. Lower interest rates are offsetting concerns about rental returns, rising unemployment, and migration losses, making it easier for investors to purchase properties. Debt-to-income ratios, or DTI ratios, remain a challenge for investors, but lower test rates and reducing rental shading requirements down to approximately 20% are providing relief. The majority of borrowers, 88%, are opting for fixed-rate mortgages, typically for 6 to 12 months, while 11% are choosing floating rates. This trend reflects anticipation of further official cash rate cuts in the near future, with widespread expectations of a 0.5 reduction on the 27th of November this month. While falling interest rates are boosting market activity, slow processing times and increased administrative burdens are creating significant headaches for mortgage advisors and buyers. Advisors emphasise the need for streamlined bank processes to better serve the growing demand for housing finance. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor and experienced property investor, and these events are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 3 from the New Zealand Herald on 19th of November. Landlord paid $4,000 after $40,000 worth of damage goes to Tenancy Tribunal. A tenant who caused $40,000 worth of damage to a rental property is being ordered by the Tenancy Tribunal to pay $4,085 in compensation to the landlord. The tenancy, which ended in July, was terminated by the tribunal due to continued and excessive damage to the home. The landlord sought compensation and a bond refund, citing extensive damage across the property. Repair costs included 11 separate insurance excess charges of $750 each, covering intentional and careless damage in multiple rooms. The tribunal clarified that landlords must prove tenants caused damage intentionally or carelessly to claim repair costs. Evidence presented included photographs showing large holes in walls, broken windows, a tampered alarm system, damaged bathroom fixtures, broken doors, wrenched cupboards, and ruined carpets. The adjudicator noted the home was newly renovated at the start of the tenancy and stated the tenant was fortunate the insurance covered intentional damage. The tenant was held liable for the insurance excess. The tenant had already paid $3,780, with the remaining $4,085 calculated after the bond refund. Serena Gibbon, General Manager of the Auckland Property Investors Association, highlighted the financial challenges caused by insurers charging separate excess fees for each instance of damage. She explained that under the Residential Tenancies Act, the RTA, tenants' liability for careless damage is capped at the lower of the insurance excess or 4 weeks' rent. However, the definition of a damage event varies between insurers, affecting claims and financial outcomes for landlords and tenants. Gibbon advised landlords to understand how their insurance policy defines a damage event, as this determines how multiple damages in the same area are assessed. For careless damage covered by insurance, liability is limited to the lower of 4 weeks' rent or the insurance excess. If not covered by insurance, liability is capped at 4 weeks' rent. My advice is make sure you've got good insurance cover. Talk to an independent insurance advisor to make sure that you've got the best protection for your rental properties. Topic number 4 from Stuff on the 21st of November, investors on the rebound and first-home buyers still strong in a sluggish market. New Zealand's property market presents a mixed picture as declining prices and rising sales fail to translate into a robust economy. According to CoreLogic's November housing chart pack, property sales in October increased by 16% year on year, marking the 17th rise in the past 18 months. However, sales volumes remain 10 to 15% below typical seasonal levels, reflecting cautious buyer behaviour amidst ongoing affordability challenges. Chief property economist Calvin Davidson noted that ample listings have given buyers more options, encouraging deliberate decision-making and better deals. Despite this, the CoreLogic Home Value Index recorded an 18% decline in national property values from the post-COVID peak after 8 consecutive months of decreases. In the 4 weeks ending November 3, new listings reached 11,549, up from 10,611 during the same period last year. Overall, market listings totalled 28,954, exceeding both last year's 25,850 and the 5-year average of 23,032. Regions like Wellington, Auckland and Otago saw listing increases exceeding 15%, although the West Coast bucked this trend with lower availability. First-home buyers accounted for nearly 28% of October purchases, driven by reduced prices and reduced competition. Mortgaged investors also gained ground, making up 23% of sales due to easing loan-to-value ratio restrictions and falling mortgage rates. Davidson highlighted the importance of both groups in maintaining a presence in the market as their combined activity supports overall stability. Although annual inflation has returned to the Reserve Bank's 1 to 3% target range, broader economic activity remains subdued. High loan-to-value ratio requirements, emerging debt-to-income limits, and tighter credit conditions continue to constrain buyers. Davidson emphasised that while falling mortgage rates may stabilise prices, a strong housing rebound is unlikely in the near term. Affordability challenges, elevated inventory, and signs of job losses are expected to weigh on the market's outlook. Approximately 66% of existing mortgages are set to reprice within the next year, which means that mortgages are coming off fixed rates and looking at refixing. So this could add further financial pressure, although to be fair, in most cases, they'll be reducing the interest rates that they refix at. Topic number 5 from RNZ on the 21st of November, capital gains tax the best way to raise revenue as New Zealand's population ages, according to Treasury. A capital gains tax is the most viable tax reform to significantly increase revenue, Treasury has advised the government. This comes amid discussions by Treasury and Inland Revenue about overhauling New Zealand's tax system to address long-term fiscal challenges. New Zealand's ageing population is projected to reduce the number of working-age taxpayers relative to retirees. This demographic shift may necessitate relying less on income taxes and more on alternative revenue sources. In a June report provided under the Official Information Act, Treasury noted that broadening the tax base, particularly through capital gains tax, was the most effective way to generate meaningful review. Other measures would likely produce only modest gains. Economist Shimabil Yaqub supported Treasury's position, emphasising that New Zealand already relies heavily on GST, corporate tax and income tax. Raising corporate taxes, he said, could hurt international competitiveness, while income taxes are already relatively high. He explained that taxing capital is a logical next step, as it's an untapped area of the tax system. Yaqub argued that this is widely acknowledged amongst economists. Yaqub highlighted that while the current system places much of the tax burden on the working population, this structure is unsustainable given the country's ageing demographics. Treasury's research showed that individuals typically contribute more in taxes during their working years, but receive more in benefits and services when young or retired. He stressed the need for a long-term plan, warning that a shrinking base of net taxpayers would challenge the sustainability of the current system. My opinion on this is that the devil will be in the detail. If they're going to do a capital gains tax, in my opinion, that people don't mind capital gains tax as long as it doesn't affect them. So property investors might become the target for this sort of tax. As you know, if it doesn't affect your family home, then most people won't be affected by it. However, having said that, if you're a property investor and you're in it for the long term, also won't affect you until you sell that property. Learning is key to success when investing in property, and the right knowledge can make all the difference. Register now for one of our free events called How to Succeed with Property Investing. These events are available both online and in person. Whether you're a seasoned investor or just starting out, our free sessions will provide you with the essential tools and insights to make smarter, more informed decisions. Don't miss this opportunity to stay ahead of the curve and take the next step towards achieving your financial goals. In our free events, we'll also tell you more about how we can help our clients achieve their investing goals. If you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up. Or feel free to book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. It's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.